Well, let's just start by going down the line. A couple sentences on your fund's focus, the sector of the state.
Sure. It's great to see everyone. My name is Baptiste. I'm an investor for Citi's impact funds, the Citibank. We invest in high impact, early growth companies across 4 pillars, whether that's future of work, social infrastructure, which includes like transportation, healthcare, as well as climate resilience and financial resilience.
Thanks for having me here today. This is by far the most interesting office I've been in New York City. My name is Arieh Levi. I'm an investor at Haymaker Ventures. We are a seed Series A fund. We focus primarily on fintech, vertical application, all that fun stuff. So nice to be here and hope to meet more of you today.
Hi, everybody. I'm Collin Wallace. I'm a general partner at Lobby Capital. We write $3 to $6 million checks. Who knows what stage that actually amounts to these days. Before this, I was a founder, so certainly spent a lot of time on both sides of the table. I tend to focus right now on sort of agentic tools as well as the new like SMBs. So like what are SMBs going to become in the future? And we are a generalist firm though, so we'll pretty much invest in anything.
Hi, this is so great. I'm Enki. I'm one of the investors at Salesforce Ventures. I tend to focus most of my time on energy, workforce, and fintech, but our firm does everything across software, robotics, AI infrastructure, et cetera. And we're Series A all the way to pre-IPO, so pretty wide range, and our check sizes vary as much as our stages do.
Right. Keep it. Just let's go back down the line and tell me how big does an exit need to be for a relationship?
It's a great question. I think this definition is changing a lot these days, particularly as we see round sizes continue to expand and entry valuations expanding. So I think it's a definition that has changed year to year to year. If it's less than $1 billion, it's really hard to look at. We're typically underwriting to 5 billion, 10 billion plus valuation or exits. If you come in early, if you're coming in later, you just have to think about the multiples, right? Like if your investors are looking at 5 to 10x multiples on their capital. So that should tell you what you need to get to at the end.
Yeah, very similar. We tend to look for companies that have a clear sight line to $100 million of ARR and can be growing at something north of 30% year over year still at that rate. If we can't see that in the business as it stands today, it's really hard to get behind it. It just doesn't really work for the portfolio math. So that tends to be the rubric that we look at.
So our fund is anchored by Thiel Capital, which is Peter Thiel's family office. And so we are sort of aligned with his belief in the power law. And the fund we're currently investing out of is a little over 100 million. So we need to assume that every investment we make can return the fund. And so assuming we get between 10 to 20% ownership at seed and Series A combined, generally $1 billion plus.
Yeah, I'd say our view on exits, mirror a lot of the sentiment that's provided earlier, similar to or exactly like a lot of these other investors on the panel, of course, seeking venture scalable returns. And I think, a lot of that is based in, the profile of that company at exit. We're looking at the fundamentals of the business, thinking about, of course, their unit economics, upside for the market that they're selling into. And then I think the broader backdrop is all based in, of course, the current market conditions, so the opportunities for exit at that point in time. And so that's generally how we're looking at it.
So, I'll ask you a couple of questions to a couple of you, and then if anybody has anything to add, just jump in. So these are mostly pre-Series A founders. It can be kind of tricky to forecast. We were talking about hockey sticks. I think it's a little tricky to forecast what's going to happen 4 or 5 years out. Why bother? That's the one.
Yeah, I'll jump in here. Well, of course, we're not looking for a perfect story when, looking at founders' models. But if anything, we just want to understand, what's true to the business, what's driving growth, as well as the potential risks. And, I think especially, if you're at the pre-seed, seed stage, and beyond, there's a lot of value in sitting down with partners that you have, whether that's, inside investors or what have you, to continue to reiterate your model and make sure that it's projecting this realist mindset, but also transparency.
So the question is why bother sort of projecting at all? You know, VC is like one form of financing for companies, and we're sort of like the cowboys of private equity in the sense that we are making these crazy high risk, high reward bets, but we still are investors, right? So like we still have to try to think critically about the companies we invest in and like make good bets. And I think the reason why we build models and, you know, project forward is just to sort of like sanity check, right? Like if I'm talking to a founder and they say the market is, you know, X, and then I say, well, I kind of did the back of the envelope math and I think it's like half of that, then we sort of have to like find a way to meet in the middle or agree on the size of the market in order for us to get the return that we need, right? So that's what we do. I think it's more of a sanity check than anything else. But it also helps the founder. Like it helps the founder sharpen their thinking about what they need to achieve to get to a good outcome, and how they can go about achieving that outcome. So,
Yeah, we don't spend a ton of time on the models. I think they're a little bit of a performative exercise. Like the easiest place for you to make money is in Excel. Like you just change the numbers and all of a sudden like your hockey stick growth company. I did on the founder side of like, I've played that exercise. I went through YC, I went through Techstars. Like there's a game being played on both sides. I think, what you're really looking for is the intellectual honesty of the founder. Like, what's their thought process about understanding, like, what is the outcome sensitive and to what extent are they guarding against, like, those externalities and to what extent small changes in certain things may have a very large or levered impact on the outcome. And so I think that's the biggest, like, goal in going through that exercise. Whatever number comes out, honestly, like it will be wrong. I guarantee you that. It'll either be like massively higher than what reality is, or it'll be massively lower than what anyone expected, or than what actually happens. And so I think, again, it's about the exercise more than it is about the specific numbers that come out of it. Thank you.
So we talked about how big the outcome needs to be for it to make sense for the fund. We talked about the exercise for the hockey stick. If you're a founder who maybe doesn't have a financial cushion or hasn't done this before, it is so much harder to build a $1 billion business than it is to build a smaller business. How do you coach that founder on how to sort of weigh that risk? You might not be feeling confident building the projection that's necessary to get the check to build a $1 billion business. So how would you advise a founder like that?
I think you're playing the same game as those that might have a cushion or are more well connected. So at the end of the day, you're going into the same investment committees as those folks, and you have to tell a similar story. You know, VCs are notorious for pattern recognition, and so they're looking at can you get to that scale, right? I think there's a lot of ways that, you know, being connected or having a cushion, like you have your expertise, you have things that you've built. And so if you're able to demonstrate that you can do what you've said you can do and execute, that speaks volumes. And so that is your cushion, right? Like cushion is not always just capital. Capital can come from the VCs who, if they have conviction in your ability to execute and build a big business, can give you that cushion and that backstop for what you need to hire and grow and build. So I think you kind of have to have a little bit of self-confidence in playing the game that everyone else is playing and making sure that you know, while being intellectually honest. I think I agree. Like we look at projections to see, can you be intellectually honest? And I'll look at things like, you know, are you selling into an industry that notoriously has 2-year-long sales cycles and you're telling me that you're going to sell to these companies in 3 months, which is like, then you don't know the industry that you're building into and selling into. And so it's almost like, how do you think you can get there? And there's always like multiple plans, right? Like there's the plan you share with investors when you're fundraising and to show like how big you can get. And then like, and we always tell our founders, like, there's always the backup plan that you have of like, here's what we think we're going to get. Here's what's realistic. And like one plan is like the aspirational growth plan. And then the other plan is like, I'm going to manage my cash around this too, so that I know how, like, I can't get stuck in a moment where I no longer have capital and, you know, need to shut my business down, even though all I needed was another year of runway and I could have done that. So I think it's a lot of different factors, but I'm a finance person, so I like having a financial plan. It's like my security blanket.
And I want to come back to the backup plan and again, questions. I would love to get this maybe Maya's perspective on how would you coach that founder that is feeling vulnerable coming into that fundraise. And I think on channel part of what you said, which kind of applied that maybe the forecasting process isn't so much about the numbers that it spits out and more about it as a proxy for whether the founder really understands the business. How would you advise a founder to approach that process?
Yeah, absolutely. And I think this connects to a bit about what you had mentioned earlier, where, maybe a founder feels they don't have that same amount of cushion, right? And so, naturally you can feel a bit more risk averse, right? As you're modeling that. And so I think the first thing that comes to mind is being able to work with those around the table, like I had said earlier, and really showing the discipline that you can have as a founder when it comes to things that are in your control in the model, like burn, for example, because that can be a proof point in its own and showing that, you're able to, of course, have discernment, right, when making those decisions and seeing how that flows through not only like the current, but the projections of your business. And I think another area where, founders can gain that confidence where they feel uncertainty is, looking at your peers in the space, right? Often, I recommend founders that may be in our pipeline to speak with founders that share adjacent or similar solutions, right? There's nothing more valuable than just gaining additional perspective and learning from one another. So those are a couple tips that come to mind.
So let's go back to the downside protection. It's in perspective from like how do you a downside protection into your model without sandbagging fundraising? Right. That's the right.
I mean, look, I think it depends on who you're talking to and the firms. I'm not mostly interested in your backup. There are no delusions for me about what exactly we're backing here. Like the way I think about it is, it's kind of like selling fuel, right? Like you have different types of vehicles. I sell rocket fuel, and a rocket has a very like clear attribute, which is it sits on a launch pad and then it has a very binary outcome after that. It either goes into orbit or it blows up. Like there's not a lot of like in between. There are pickup trucks, there are 747s. They all take very different types of fuel and they provide a very different type of ride, right? An airplane can go up and go down. It's very comfortable. Pickup truck's really reliable. It takes 87 unleaded. Like it's cheap. It's easy. Depending on what vehicle you are building, like I may or may not be the right fuel for you. The biggest disqualifier for me is someone comes and they're building a perfectly good Learjet. They're building a perfectly good 747 and they're asking me for rocket fuel. And I'm saying, if I give you this fuel, it's going to blow up your perfectly good plane or your perfectly good pickup truck. And if you put 87 unleaded into a rocket ship, it's not going to go anywhere. And so like, I think that ends up being this element of qualifying the capital in the same way you qualify your customers, like before having the conversation. And so when you come to me and say like, hey, here's my backup plan for when my rocket doesn't go into orbit, I say, well, you're not building a rocket then. You're building like a helicopter that's going to go up and you'll parachute out or some other thing. Let me introduce you to somebody who sells you that kind of fuel. And so like for our firm, it's not interesting. I think maybe for others, maybe it is like angels. Maybe that's like a more compelling like argument. And you might have thoughts to add to it.
I think that's like 100% right. As we talked about earlier in the conversation, we have to satisfy these wild return requirements. So we need the companies we invest in to be rocket ships. Most of the companies I meet are not rocket ships. They come to me and say they are, and I say, I don't think you are. They should, like, they'd be better served recognizing that and building a great Learjet and building a great plane like Cruise. And not only that, they'd actually make more money building the Learjet because they'd have less dilution, right? And so when they exit, they own 80% of the company instead of owning 10% of the company after raising successive rounds of venture capital. So I think like, VCs have like this mystical aura around them that they really shouldn't have. And it's just a financing mechanism and a financing tool.
And what sort of advice would you give around what not to do?
Yeah. A couple that come to mind is, when folks aren't considering churn in their model. Another one that comes to mind is, not being realistic around CAC, especially when widening your distribution channels or entering new markets. There's always going to be some hiccups or just things that you don't anticipate. So I think building that into the model is really important. Those are two that come to mind. The third one that just slipped, but hopefully that's helpful. And I think ways to mitigate for that sort of goes back to what I had said earlier, right? Sitting down with investors or just folks that you value their perspective from and being able to reiterate as you go goes a long way. And I often find that those are the founders that are creating stronger businesses and faster, being able to show that resiliency and adaptability as they go.
I think one is just an unrealistic sales team and how you're actually going to go to market, and that not matching up with the realities of what you're selling and where you're selling into. And then the other is going back to our prior conversation, not being aggressive enough in your growth. Because if I look at like, especially if you're Series A, you should be growing so fast in 2 years. And if I look at a financial model that tells me like, we're going to grow 100% next year, then I think like, okay, that's great. That's a nice plane, maybe a helicopter. But that is great growth. It's just not what I would look for at a Series A company. And so if those don't match up to what the expectation of investors is for what you're supposed to be building, I feel like I'm just echoing what folks said, but that to me is like, especially at the pre-Series A stage, like that's the number one thing that I look at is, can your sales actually match what you're saying you can do? And how fast do you think you can get there?
Can we oh, sorry. Yeah. I just want to talk really quick for a second about like the actual mechanics of venture. Just so like, because I didn't really understand it as a founder until I sat on the other side of the table, like what exactly the target looks like for us. To put it in perspective, we're a $200 million fund. We'll write 20 checks out of that fund. We'll buy roughly 20% ownership in those companies. It'll be 10% by the time we exit it. 12 out of those 12 companies will go to zero. Like statistically, if you're really, really good, 12 out of 20 will go to zero. 6 of them will return something like 50 cents on the dollar. So basically 2 companies will have to pay for all the flights to Williamsburg, the nice hotels, like the fancy shoes, the fancy dinners, all your LPs, 3 times the capital they invested, right? So 600 million to them, 120 million that goes to our firm. So 720 in total. 2 companies, the 10% ownership that we have in them has got to pay for all of that. Or you're a bad VC and you don't get the next fund. And so when you come through the door, this is literally like what we're evaluating you through the basis of. Like, if you are one of these 2 companies, which maybe you are, maybe you aren't, will you return $360 million to us, not to the like whole, everybody who's in the cap table, all the employees, like to our firm owning 10%. And when you look at it through that lens, you can see there's a whole slew of companies who are great companies. They will do awesome. Bruins will do awesome, right? But also will not fit into our portfolio. And so you end up saying no on that basis, not because it's a bad company, but because it just doesn't fit what the thesis is for that type of capital and the expectations from our LPs. And so I think it really like helped me understand like why the sort of gate is so narrow in many ways.
I think it's also like just being honest with yourself about the type of capital you want. Like I totally agree on like venture is a very specific type of capital. And then if you bring in a venture investor into your board meeting who has certain expectations and you and the rest of the board have very different expectations, it also, I think, just creates a disbalance and more chaos for you as a founder, because now you have 2 different viewpoints as to where you should be directing your company. And I don't think that helps anyone. Like chaos doesn't really help anyone. But
Except for Elon.
I've been seeing this happen across the last 18 years from inside. And Charlie and I actually just talked about this 2 weeks ago in the last webinar thing that we did. Series A, pre-Series A, it's hard for a founder to know what it could be, right? You can have this sort of unconstrained ambition and but we've seen a lot of capital create pressure for founders to build companies that, are not, it turns out, that are exitable. In the webinar with Charlie, we talked about Casper, the mattress company. It's a crazy influence. Like they turned down a $900 million acquisition offer from Target, only to go public 2 years later at 300 million. That's a terrible outcome, but it's a function of exactly what you're talking about, like the sort of complexity of the different people sitting in the board meeting, and what is great for founders, what would have been an incredible outcome for founders, not actually making the hurdle for the investors. So straight talk, but this is the time to understand it, because the decision that all these companies will make in this here today, it's going to have a really profound impact. And we're so eager to get the check as founders that you really want to be whatever you need to be in order to get the check. And sometimes it's let me ask go to Maya and then Ari. Knowing all that and knowing it, it's Pre-Series A and the model coming together, should founders come to you before the model is fully baked? Or like, do you want to see it and then help coach it? Or should it be completely dialed in before it gets in front of you?
Yeah, I think, as I often work with the founders in our portfolio, maybe they're considering a follow-on financing or something of that nature. I often see them bring me a pretty well-baked, model. Granted, it depends on the stage of the business and maybe the amount of knowledge or support, that founder has in their team from a financial perspective, right? Whether they have a fractional CFO, if they're doing it themselves. I think just the amount of expertise, right, that they have in building that out will just depend on the business. As I think to seed stage founders that I've worked with, I absolutely do not mind when they bring a model that's not fully baked because I think it creates room for flexibility, right? And to build in different perspectives and assumptions that they may have not thought about. I think it generally depends on the stage of the business, but I don't think a founder should ever really feel all that hesitant with bringing something that's not fully done because it's always going to be evolving and changing with time.
I think the model at Series A, to some of your points, it's really just like to get an understanding of whether the founder understands their business. It's a way for us as VCs to like assess, is this founder, like, how does this founder think? Like, how do they think about their business, the market? Do they, understand the levers they can pull? Are they making logical assumptions? So like, I don't really care if it's half baked as long as I can see some of that. And if I can't see some of that, then the next question is, does the founder want to get there with the model? Like if I ask them for time to discuss the model and then I suggest things and we have like a good sort of like conversation about what it could look like and the founder is receptive, then that's also like a good thing. But it does call into question how much the founder knows about the business, right? So if I, start raising what I consider obvious points and the founder's like, oh, I hadn't thought of any of that. It's sort of like, well,
Why not?
but like, no, we're not expecting every founder to bring us like a Goldman Sachs level financial model. That's not the point.
Although maybe now with Cloud Code,
Yeah, maybe now, but
But Claudia shouldn't have any excuses about like not having a fully baked model. You might be wrong, but like it should function.
yeah, well, not very good, but that's probably me, not the AI.
Collin, you've written about software as the SMB, and we've talked openly here about the range of outcomes for any given outcome. Inherent in all that is the dynamic where the capital that you put into the business at the valuation that you put it in at is going to be to some extent deterministic of the outcome. So if you're a founder thinking about managing your founder outcomes and the possibility of a range of raising different amounts of capital, different valuations, are you putting in 10 at 100 or are you putting in 30 at 300? And if the founder actually has to make that choice at the Series A, or you're not making that choice at Series A, but you get my point. Just given what you've written on, how do you think about that dynamic? Like, are you sort of hedging for future optionality around the size outcome, or you should just go for it, YOLO, and get as much as possible can, on top?
Yeah, so I think there's a lot more efficiency in the markets than probably there ever has been in terms of just the options for you, whether it's Kickstarters or AngelList or Angels or like YC, Antler, Text. There's just so many different types of capital and so many different pockets that all have kind of different attributes to it. So I was a founder a long time ago. I built a company called Fango. We merged with another company that became Grubhub for like ordering food from restaurants and so on. And at that time, like there weren't that many options. It was like either your company like IPO'd or you were screwed. There wasn't really like secondaries. There wasn't like a get off ramp. Like it was like you were in this thing and oh, by the way, like you couldn't get any of your money out until everyone got their money out. And so like risk was all on or was all off. There wasn't really like a whole lot of moderating in the middle. And a lot of that risk came in the beginning. So it was really expensive to start a company. I remember like buying servers off of eBay, setting them up in our laundry room and then like illegally hosting credit card numbers, which it wasn't illegal at the time, but like it later became illegal to like not have secured like boxes or racks for credit cards. And so you needed to get like a lot of money up front to like get going. Like, and if someone had like made progress, it was very clear that they really had something that was working because there was no other way for them to have manifested it. It's very much changed now where like you can get really far with like very little, like with literally a couple $100s of tokens every month. Like you can write a tremendous amount of code. It's funny, I rewrote a bunch of like Git repos that I had done when I was building as a founder. And like within a Saturday afternoon, I had rewritten most of what took me 6 years to write as an engineer before. And so I think it changes the risk profile a lot in like when capital needs to come into your business and how much you actually need it versus like in some cases, people just want the vindication that like, oh, I've raised money from VC or I have dollars. It makes me feel good. It's a pacifier as opposed to like, I actually need this to really grow my business. And so I think making that assessment of your company is really important. And for you being honest with yourself about what do you really want to do here? Like, do you really want to build a massive business and all the pressure that comes with that and the people and the VCs and the board meetings and the quarterly reports? Or like, do you just want to retire to Maui and like, you know, or buy a house in the Hamptons? Like there's lots of ways to do that that don't require all the excess, you know, stress and anxiety. And so usually when I see like a founder decide to go a different route, they realize like that seed was always there, that they didn't really want to be on this ride, but they felt like they needed to be because it was the thing to do and all their friends were doing it. Oh, I don't want to go back to Bain or like wherever. So I think having that assessment for yourself or that honest conversation is really important.
Yeah, I completely agree. I think we can build so much today that we couldn't a year ago. I think this is a conversation we're having with portfolio companies and companies that are coming in. I think especially for companies coming in for net new investment, it's like, what are you doing different? And like, why do you need venture to scale this thing? And it's back to like the rocket ship. Like if you want to be a rocket ship, then like, and you just need to go as fast as possible and you have something that no one else has, like take the money. But otherwise, like, there's a lot of ways to buy a house in the Hamptons.
Today, speaking of AI, we haven't seen our company get started. Like, we produce product and also have a good role. To see what are the kind of functionality that's seeing in the data system that I'm never found.
Yeah, for yeah, so I can talk about this a little bit. Like we talk about the balance between could and should, right? Like the list of things that you could do is like infinitely long. It's gotten longer because of AI. It doesn't impact the should. Like, should you build this thing just because you can do it in a weekend? It doesn't mean it's actually a good use of your time. And so, like, I think the really talented founders are they're very acute about staying on track with like what's actually going to drive progress in their business versus just like adding stuff to their product because it's easier than it ever was before. I think about like Mario Kart because I grew up in that era where you get this like magic mushroom and it turns out like if you're pointed in the right direction and you shoot that mushroom, like you're going to go really fast and you'll cover a bunch of places. And if you're not pointed in the right direction, it'll just shoot you off the track. And the next thing you know, like the little cloud is like having to bring you back on the track and so on. It turns out it's like wildly disruptive. And so like that focus and that like evaluating whether or not you should be spending time, money, energy on this thing, even though again, you could build it easily, it's way more important than the fact that you can just go really fast because of AI. That's sort of how we look at it.
Yeah, I think especially with like, it's like, what are you trying to achieve? And usually like we're thinking about, okay, are you trying to get deeper into your customers? In which case build towards that and get paid for that and like expand your ACV or, you know, like how much the spend is with each customer. But that is a very targeted, focused way to leverage these new tools. If you're like all of a sudden starting up like a whole new sector, and, like doing a consumer app, if you're an enterprise, you know, like there still needs to be some strategy around what exactly you're trying to achieve. You can build much more like deeper products now, and that should continue to happen. But I completely like focus is still paramount. Like I said, I don't like chaos.
I think like there's sort of like an underlying assumption in your question, or at least I read it that way, but that software is a commodity now in the age of AI. And from what I'm seeing, for every one company that like 5 years ago had 5 competitors, there are now 30. And I think that number only increases. The pricing power is effectively gone. And for every company that I meet has some vision of how they become a platform. But the incumbents also have that vision. And they are also able to build as fast as every startup now. And every startup can build as fast as every other startup. So everyone sort of converges and competes. That's all a little bit bleak.